Low interest rates and low inflation may be the new normal. That's according to Darryl White, CEO of BMO. He told me investors should be prepared for rates to stay lower for longer.
It's also possible that normal is a new normal, which says let's get ready for and used to an environment that has both low rates and low inflation. Because it's not true that there's no inflation. There is inflation depending on where you look geographically and whether you look at consumer or you look at input costs. You can see 1%, 1.5%. In Canada, closer to 2% target inflation. So there is a reasonable amount of inflation in the market. And in the US we could use a little bit more from a policy perspective. But then at the same time, you have to get used to a low rate environment. And we've had movements that have been on the surface at the macro level would appear quite volatile over the last 2 years. But when you trend it over time, you step back and look at it with a lot more aperture, you can come to the conclusion that we're in a low for long environment, both from a rates perspective and an inflation perspective. So I think where we are now, is actually reasonable.
One of the places where some would say Canadian banks need to adjust back to normal is on loan provisions, loan losses.
Yeah.
Is there an argument to be made there that you could be more aggressive on what you set aside?
No, I don't think that you ought to become more aggressive as a matter of policy. You don't wake up one day and say, I have a different view on the environment than I did yesterday, so therefore let's make a decision that we're going to carve out more and put it in the basket and say that we're going to set that aside. What you do is you spend time with the models and with the people who are experts around the models, risk people, business people, economists. And what we do is we develop a point of view on probabilities of many events, whether it be recessions or tail risk, or the differentiation between the book's quality over time. Mm-hmm. And you come to a fundamental view as to what the right set aside is. It's not prudent in my mind to wake up one day and say we're in a brand new world, therefore yesterday we set aside this and tomorrow it'll be that. It's evolving, it's dynamic, and it goes through a rigorous process.
And in the mix there, obviously household indebtedness in Canada is flagged as a key concern, and the housing market still pretty volatile, still pretty hot in pockets of this country. Are you in the camp that thinks more needs to be done to cool it, or that the rules as they're in place now have worked?
I think if you go back a year and a half ago, we had a lot of change, didn't we? We had rate increases, we had B20 coming into play, we had foreign buyer taxes in 2 big jurisdictions, and in large part they had the desired effect. So while sure there's volatility in residential house markets, housing markets broadly, but if you look at the period of time over the last year and a half, we haven't had any big policy moves. We've actually entered a period of relative stability. So we're going to have movements in different markets over time, but the fundamental of supply and demand that should drive a stable market and a rational outcome is much more present today than it was a year and a half ago when we had intervention to stabilize a market. So we're always, I would say, appropriately concerned about the housing markets in Canada, but at this point in time, we're a lot more in balance than we were at that point in time. So I think we're in good shape.